Hi guys, it's me, Angelica Calero. Oh my god, I'm not ready for my vlog today and tonight because it's already night. Okay, Mag- I'm just. Oh my god, I'm so pretty. See you later. Bye. Hi, welcome back. How's my look, girl? How's my look?
Hey, beautiful, 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 beautiful angel. Love your imperfections, every hand.
Okay, enough with that video because it's not part of our agenda tonight because we have another agenda. So let's go. First, I have to apologize because of my messy background. Look at that, it's so crumpled. Even at my eyes, it's not so presentable at all. And also, I'm not fluent in English, so bear with me, please. I'm not that good.
What?
But it's fine. At least I can talk in English. So, let's get started. Statement of the financial position or balance sheet is the financial statement that reports the assets, liabilities, and equity of a company on a given day. In other words, it lists the resources, obligation, ownership details of a company on a specific day. You can think of this like a snapshot of what the company looked like at a certain time in history. Statement of the financial position is formatted like the accounting equation, like assets equals liabilities plus owner's equity. The assets are always listed first. So, in the assets section, assets are the resources that the company used to create goods or provide goods and generate revenues. There are many ways to format the assets section, but the most common size balance sheets divide the assets into two subcategories, which is the non-current and current assets. Assets include cash, account receivable, and inventory. These resources are typically consumed in the current period time or within the next 12 months. Non-current assets section includes resources with useful lives of more than 12 months. In other words, these assets last longer than 1 year and can be used to benefit the company beyond the current period. The most common non-current assets include the property, plant, and equipment. So in liabilities section, liabilities are debts obligation that the company owes other companies, individuals, and institutions. These range from commercial loans, personal loans, and mortgages. This section is typically split into two main subcategories to show the difference between obligations that are due in next 12 months, current liabilities, and obligations that mature in future years on long-term liabilities. Current debt usually includes accounts payable and accrued expenses. Both of these types of debts typically become due in less than 12 months. The long-term section includes all other debts that mature more than a year into the future like mortgages and long-term notes. So in equity section, equity consists of ownership of the company. In other words, this measures the stake in the company and how much the shareholders or partners actually own. This section is displayed slightly different depending on the type of entity. Example, a corporation would list the common stock, preferred stock, additional paid-in capital, treasury stock, and retained earnings. Meanwhile, a partnership would simply list the members' capital account balance, including the current earnings, contribution, and distribution. In other words, of non-profit accounting, this section of the statement of financial position is called the net assets section because it shows the assets that the organization actually owns after all the debts have been paid off. It's easier to understand this concept by going back to an accounting equation examples. If we rearrange the accounting equation to state equity equals assets minus liabilities, we can see that the equity of a nonprofit is equals to the assets less any outstanding liabilities.
You can see from our example template, each balance sheet is listed in the accounting equation order. This organization gives investors and creditors a clean and easy view of the company's resources, debts, and economic position that can be used for financial analysis purposes. Investors use this information to compare the company's current performance with past performance to gauge the growth and health of the business. They are also compare this information with other companies' reports to decide where the opportune place is to invest their money. Creditors, on the other hand, are not typically concerned with comparing companies in the sense of investment decision making. They are more concerned with the health of business and company's ability to pay its loan payments, analyzing the leverage ratios, debt levels, and overall risk of the company gives creditors a good understanding of the risk involving in loaning a company money. Obviously, internal management also uses the financial position statement to track and improve operations over time. Now that we know what the purpose of this financial statement is, let's analyze how this report formatted in a little more detail.
Does the balance sheet always balance?
Is that the balance sheet is always in balance. Just like the accounting equation, the assets must always equal the sum of the liabilities and owner's equity. This makes sense when you think about it. It's because the company has only three ways of acquiring new assets. First, it can use an asset to purchase a new one. Second, it can also take a loan for a new purchase. And lastly, it can take money from the owners for a purchase. All of these three business events follow the accounting equation in the double entry accounting system where the both sides of the equation are always in balance.